Technological evolution is happening today at the speed of light, it seems, and every aspect of our lives is more and more dependent on it. And as investors and employees in these promising tech companies, we're excited to participate in the economic gains that this great technology evolution is fomenting. The traditional path for investors and tech employees to achieve liquidity on their bets has been either through companies going public or by getting acquired. These liquidity events are usually happy days for investors and employees, but market vicissitudes are changing the options for investors holding equity today. According to SoFi, an average of 187 firms went public annually between 2001 and 2011. However, following the boom in IPOs in 2021, the number of companies that went public during 2022 went down nearly 81%. And according to CB Insights, many unicorns have raised significant funding, over $300 million at the median, to reach a $1 billion valuation. But CB Insights has dubbed the unicorns of recent years overfed unicorns. Many of these companies have seen capital efficiency suffer. They took a look at the valuation to funding ratio to reveal how efficient a company has been in translating funding into value. Unicorns of 5 years ago relied less on outside investment to build their valuation, when the median unicorn exited at a valuation of 6.9x its funding. Today, that median ratio has fallen to roughly 2.3x. So while equity is one of the most powerful tools in the founder's toolbox to attract and retain the best talent, for early investors and employee shareholders, a longer road to IPO poses certain challenges. During economic downturns, keeping morale high is key to staying competitive and resilient. What is a founder to do? So it's great to be able to introduce to you our featured speaker today, Steve Lord, to help us understand the options that founders face. He'll also be discussing with Karim how macro financial environments inform our own investment profiles. And it's worth asking, in the mix of so many technological and market changes, are public markets now obsolete? Steve is the managing director at Fintech and the crypto practice and the New York CFO practice lead for Burkland Associates, a nationwide fractional CFO, accounting, tax service, and people operations provider for startups. And I'm a big fangirl of Burkland Associates. You should all check them out. Steve listens to the excitement of early stage founders he's advising who have aspirations of taking their companies public. But all seasoned founders know the road is long with many unforeseeable twists and turns. Stephen has helped more than 600 companies grow from early stage on. So with that, I hand things over to you, Karim, to kick us off.
Thank you, Shelley. Steve, before we get into this exciting topic, let's go a little bit deeper into your background and why it is that you're here. What is your background coming back from the educational environment very quickly through your experiences with startups? And I know that you helped a company or several companies going from zero to IPO. So just give us a little bit of your background that's not been covered already.
Sure. So I have been, most of my career, almost all of my career has been spent in smaller companies. I came out of school with a business degree and immediately started working for a small firm in Germany, actually, as a research analyst, and really started learning the tips and tricks about how small companies get turned into big companies, what they encounter along the way, and more importantly, how public markets interpret what they're doing and how that translates well or not so well into the public, price or perception of their stock. Came back to the United States after I felt like I was living in Germany a bit too long, thinking in German, dreaming in German, all that good stuff. Came back here and began working right away, almost immediately, in management of small companies. Took a couple through M&A, ended up becoming the CFO of a company here in New York that we ended up selling to Jim Cramer's outfit at TheStreet.com. Was looking around for, dabbling in a few things here and there when I was approached by Burkland to stand up the New York office. In the interim there, we've worked with, as Shelley mentioned, and thank you for that intro, Shelley. I was like standing up straight when you were saying all that. There is a huge shift in what the typical startup life cycle looks like from when I first started advising startups in the mid-90s through to today. And that includes what it feels like to go all the way through from 3 guys at a laptop with a good idea through filing an S1 and actually ringing the bell on the NASDAQ, and everything in between. So I've kind of done a lot of that stuff, seen how it works well, seen how it works not so well, and like I said, everything in between. So that's me.
Thank you. And this is important. So let's get right into it with the topic title. Are the public markets, should they be obsolete?
Should they be obsolete?
Should they be obsolete? And walk us through what you think the public markets were created to do, what they're doing today, and what the future looks like. That's a lot. So however you want to start.
Yeah, great. I mean, I think people have to understand where public market activity came from in the beginning. Way back in the day, you sold shares to a public market in order to raise capital so you could grow your business. It was really designed to provide operating capital for a company to expand. If you go back 200 years, 150 years, when I worked in Germany, actually, the founder of our company there had an original stick from the UK, and that was where the word stock came from in German, with a certificate wrapped around the end of the stick, and you would trade those sticks in return for money, and that would be the money that your company needed to expand. Go back to the robber barons, the railroads, any new cycle in the economy, industrialization, whatever, has been financed primarily through the sale of shares onto the public market, sometimes also accompanied with the share of debt onto the public market, right? And we've developed this extremely efficient mechanism. People forget what Wall Street is really there to do. Wall Street is the world's most efficient sales organization. It takes financial instruments and it sells it out to people who have money. That's the gig, right? But I think particularly when you were sort of leading into the conversation, and the title of today's discussion is really important because the reason why people are going public now is increasingly different. They're now cashing out. The typical IPO is not so that I can expand. A founder can raise all the public market equivalent they need in the private markets, VC, private equity, private credit, right? Shelley was mentioning in the intro this spike in IPOs that happened in 2021. And when you look at a graph, you go, oh, well, IPOs are back. They're not. Most of those IPOs were SPACs, special purpose acquisition companies, which are a backdoor way of getting public. So they don't really count in the true sense of why companies would go public. Today, founders have to look at why do they want to be public? Is it so they can cash out and everybody makes $1 billion? Terrific. But that's not the same reason why public markets were created in the first place. And they're not really well suited for that kind of terminal outcome, because you're selling stock to all of these people under the premise that it's going to grow. So, you're changing the ground rules a little bit on the game. I think the mechanism for taking a company public is still very valid. Where I think it is obsolete is in how it's doing it, and why I think that is the advent of a lot of technology has collapsed and will continue to collapse gaps in the way companies sell equity out to the marketplace, whether it's a public marketplace or a private marketplace or a mix of the two, is going to increasingly get a little blurry. And how that equity changes hands from one person to another, or from the issuer, right, the company, to a collection of investors, is going to get more and more and more technologically savvy, faster, cheaper. The T+1 settlement we have now, it used to be T+3, and eventually it's going to be T+1 hour. Maybe it'll be T+1 minute, but all of that infrastructure is going to get faster, cheaper, and cleaner, which removes the need for a lot of this public market infrastructure. So I think the nuance is not that the mechanism of, quote, going public is obsolete. It's more around, what is the definition of public nowadays? Is it a private investor? Is it a publicly traded stock? Or is it something in between? That's where I think the obsolescence is becoming more and more apparent.
So looking at the demographics that we're speaking to today, and about us, and about the enthusiasm that a whole community, a whole generation, maybe 3 generations. If we look at the last three generations, that would be 75 years. And we're looking at, this is how we grew up. You know,
Right.
the idea was put your money into a 401k that's invested in the public markets,
Yep.
put your additional cash into the public markets, gather a return of, depending on the decade, between 4 and 8% on a recurring basis. Does that still hold true?
Mhm. From a macro perspective, I think so. From a micro perspective, it all depends on when you do it. You know, in one of our pre-calls, we were talking about the fact that a person who's in that initial generation, maybe they're 25 years old, they've never really been conscious, you know, economically anyway, when the 10-year Treasury note was over 5%. They have never experienced a world where money cost something. So their perception of what markets mean and how markets function is very skewed. And then take the other expense, or the other, what's the word? I'm blanking on the word. The other extreme, there we go. The older generation, that what you just described, that was lockstep, right? Put the money into the market, put a diversified fund together, right? Buy the S&P, go back to sleep. You're going to make money hand over fist over a 30-year period. I mean, then we come into these exogenous events like the financial crisis in 2008, like the pandemic, right? Like this zero interest rate period we had from 2010 through last year. Those things skew that sort of rote like thing that we've all dealt with for years and years and 3 generations. Now that's changed a lot. That has really the underlying framework, the foundation of that 3-generation experience has potentially changed. And one of the reasons why it's changed, again, is that macro overlay. Everybody's financial expectations exist within a broader macroeconomic context. And these things are much longer in cycle than most of us have a horizon for. And that's why we lose sight of these things. I mean, maybe this would be a good time to show that chart we talked about. Let me put this up quickly for a minute. Put on my old man glasses. So do you guys see the Treasury bond chart? Just somebody nod or thumbs up or tell me that you can see the chart. Yes?
Yeah.
Okay, what this is showing everybody is the 10-year United States Treasury bond constant maturity yield since 1965. What you're seeing, and what I really want to call out, is that 3-generation dynamic you just described has happened. If you go from 1980, like think about that, that's 43 years ago. That has happened. That expectation has been built around a period of very consistently declining interest rates in the United States. Sure, there's been volatility. Sure, it goes up and down. There's a couple economic cycles in there. But if you look at the left side of the graph, you see, 4 shaded areas which indicate a recession. And then if you look at the middle all the way to the right side of the graph, you only see 3. The business cycle smoothed out, interest rates declining long term in a broader cycle that anybody's really tracking, underpinned equity performance over those 3 generations. We've probably bottomed on that now. We had 10 years of virtually zero interest rates, certainly on the short end. We have not had a period like that really in economic history where you have zero interest rates for almost 10 years, right? Negative interest rates in many cases. So I think it's really important to show everybody and to have everybody realize that the very long cycle of declining interest rates has underpinned equity outperformance. Now, I'm not necessarily saying that we're now going to turn around and go the other way, but over really long periods of time, that macro backdrop changes how things like equity and the cost of capital for a startup, how they're being perceived in the marketplace. And then that changes the marketplace's expectation about what equity is doing and what debt is doing, right? Let me stop sharing this. I'm going to show you another one that gives you a shorter term look at this. Everybody's talking about interest rates right now, right? And what that means for everyone. Let me show you this screen. You guys now should see the US Treasury yield curve with a red and blue line. Yes, somebody nod, thumbs up. All right, thank you, Karim. Okay, what this is showing you is a very sort of like live view of what the Treasury yield curve is today. That yield curve right now is the red line. And you see that it's inverted, right? Short-term Treasury or short-term interest rates yield you more than long-term rates. That's backwards. The traditional yield curve is actually the blue line that was from 2018. And that's a traditional yield curve, albeit from an extremely low level, right? You see the 1 month T-bill was only 1.6. For a while we had it. If I showed you guys this even later, it would be lower. But at least it inverts. At least longer term bonds provided a higher yield than shorter term ones, because of the idea that inflation will eat away a little bit at those bond yields, and you should get paid more risk, paid for more risk the longer you go. An inverted yield curve, especially as wonky as the one we have right now, look at this for a minute. 2 month, 3 month, 4 month bills are yielding 5.2, 3%. A 30-year United States Treasury, 30 years, that almost one of those whole generations we were just talking about, yields you 3.6. So you have no incentive to go long in your yield portfolio. What does that mean for equity? I'm going to tie all this back to equity, right? Right now, you're a fund manager, you got $1 billion under management. You are paid right now, annualized 5.3% or 5.2% on a 3-month Treasury bill. That is a headwind to equity markets because I can generate a return there without taking equity risk. I can buy the risk-free instrument in the world, the United States Treasury bond, and I make 5% a year, roll it 3 times, and go back to sleep. So when we look at how equity markets in the public sphere trickle down into the equity market, so to speak, in the private sphere, this is the macro headwind that we're facing right now. This is why everything is so sort of upside down and why it feels so strange for everybody, because we haven't had this in a very long time. In recent memory, we have not had a yield curve this inverted and this wonky. And this is what's causing a lot of these dislocations. When you want to know what happened to Silicon Valley Bank, it's this red line. That's what happened to Silicon Valley Bank. They were not able to navigate that. So I'll pause there. I know that was really wonky and kind of like macro-y. Everyone who went to business school is having flashbacks of their macroeconomics classes. But I really did want to put that out there because this is the environment in which we're swimming. When you say, how warm is the water, and everybody indexes whether that's too warm or too cold for them to go swimming. The temperature of the water in finance and in equity markets is that yield curve. It is that interest rate construct.
So thank you for that. That actually creates a great perspective on things. And so if we look into the current equity markets, and it seems like we're really focused on a lot of the narrative that comes from the news outlets and the business outlets, call it CNN or CNBC or Bloomberg. And the question that always bothers me is that all of a sudden we're talking about 3, 4, 5 stocks. Meta did really well. All of a sudden it was losing a ton of money. Now it's making money by firing 12,000 people, and all of a sudden they're doing a buyback, and suddenly everything looks good. And the market that we pay attention to seems to be rising because of some of these returns. On the other hand, if you manage that if you compare that to, those are the large caps, well-recognized companies that folks are doing research on, but there are hundreds and thousands of other companies in the public markets that probably are not seeing the same pickup.
For sure.
But so is there any indication from the news that we pay attention to of the broader underlying market that we're not paying attention to? What's the the disconnect or connect between the two?
Yeah, that's a really good question, because in an environment like we have today with this yield curve inverted, right? Large caps, big, the Dow, the S&P, those, Meta, all these trend stocks, they tend to get all the capital because, it's the old saying that no one ever got fired from a hedge fund for buying IBM. It's a safe place to be. There's a lot of attention. There's a lot of volatility and a lot of liquidity in those shares. And the other thing that people don't tend to talk a whole lot about, which is to your point, is the upside down economy, these inverted yield curve situations that I just described tend to impact smaller companies harder. They are usually the first to emerge from a difficult economy, but they are usually the hardest hit and the first to get hurt when the economy is beginning to really encounter a headwind. So when you look at small cap stocks, right, they're tending to not have a whole lot of sponsorship in public markets. And that's what this is really all about. Who's buying what and with how much firepower are they buying it? You can make any stock go through the roof if you put enough power behind it. And this is the thing that people realize. You have short-term trading, and that's trying to bet on a price movement in pretty short increments. And remember, guys, Wall Street thinks in 12-week increments. It thinks in quarterly horizons. No one running a company thinks in quarterly horizons, or they shouldn't, right? So, Zuckerberg at Meta, he's not thinking in quarterly increments. He's trying to build the future. Elon Musk, he's trying to change the world. He's got to deal with the 12-week horizon because that's what Wall Street makes him do. But he's not planning that way, right? But Wall Street thinks the other way. What have you done for me lately? You're only as good as your last trade. Now, take a step back from that. Investing is the longer term generational trends we just talked about, right? You buy stocks that are strong. This is the Warren Buffett mentality. Buy good stocks that are led by strong managers that have positive cash flow, return on equity, all of these markers, and leave them alone. Let them grow. But it is a fundamentally different mentality, trading versus investing. And I think increasingly there is more and more attention paid to that trading philosophy, and that's partially also technology, right? Wall Street bets and these meme stocks and all that sort of stuff, because the speed with which we can transact and the ease and the inexpensive nature of transacting has gotten so low that we could buy stocks right now. You and I could go to our browser, click a couple buttons, and boom, you're a shareholder. And that's created more dynamic and more volatility there.
I actually do want to talk about how Linqto is playing in this market space for private companies versus public companies. But I'm going to leave that. I'm going to hold myself back for a second. I do want to pay attention to a little bit of your background, which is working with small and medium-sized businesses, understanding, and you took a company public. Walk us through some of the challenges, the benefits, and downsides of going down that path and actually taking company public.
So I think the number one thing you have to think about there is, why are we doing this? Like I alluded to earlier, are we doing this so that we can sell 20% of the company and get money in the door to grow? Maybe that's the reason. As a CEO, I might be able to do that faster and cheaper in the private markets now than I do on the public markets. But that's the first question, is why are we doing this, right? And if it's to cash out, to get everybody a monetization event on their equity, maybe I've been privately backed before this and my VCs want to have a liquidity event. There's lots of, those aren't bad reasons. They're just different reasons than investing back into the business. So that's the first thing. And then I think it's also very important for founders today to understand what that really means, right? So going from running a private business with, say, 5 or 6 investors on your cap table, or maybe even more than that, maybe 30, right? Say really crazy cap table, lots of investors. That is a discrete set of challenges, right? You've got to manage those folks. They have expectations. You need to report to them. You have a board, and all that's great. But now translate that to the public market equivalent. Now you've gone through a public offering, which is an entire process unto itself that requires usually, I mean, there are some ways to do this nowadays without the same rigor, but take the generalist approach, the old school approach, you need to get an audit, right? Which if anybody's ever gone through one of those, that's a thing. You need to price, you need a book runner, you need to have Wall Street involved, because remember, what is Wall Street? They're really a selling organization. So someone needs to take your equity and pitch it out to everybody in the marketplace, right? So there's that whole process. So say you go through all that and poof, now you're public. Now you've got 6,000 shareholders, not 30. They all hold you accountable every 12 weeks to what you said you were going to do and whether you did it. I had a shareholder that called me every day to ask me if I had accomplished anything that day for his 100 shares and why was I worth the money he was paying me. And he called me every day. You shift from spending 80% of your time running the company and 20% of your time managing the shareholders to the other way around. You spend 80% of your time dealing with this public market facet of now the business that you run. And at least in my case, and I think a lot of public market CEOs would agree, very little time, or at least not enough time spent on growing the business that you've sold to that public, right? And then think of all of the, and this is not a reason not to do it. I just think it's important for founders to understand this. Think of all of the administrivia, the regulatory and compliance aspects of being public. You go from being maybe audited once a year to probably doing a mini audit every quarter. You have to have all of these legal compliance, requirements, SOX, Sarbanes-Oxley, all of these things come into play now into your worldview as a CEO that you didn't do before. I had a saying for years, never put yourself intentionally into a regulated finance environment unless you have to, because it's a thing. So I'm not saying don't do it. I'm just saying know what you're getting into before you do.
Let's hold on to that regulated finance environment because we're going to talk about DeFi and distributed ledger just in a little bit. But I do, so here's the other question in regards to taking a company public and being backed by investors. And sometimes we've seen over the last, maybe 12 years, I think now, that there's been so much liquidity in the market, especially from the yield curves that you showed. It's like, if we're not going to get any money on the yield curve, why don't I put it into a private company that I can then push to go public? So you've got a lot of companies, a lot of VC companies that have poured a lot of money into private companies, and really perhaps it looks like totally overvalued the fundamentals of that business. And we've seen that collapse around us over the last year. Not even 4 years. Within the last year, valuations have collapsed, at least on average 50%, and some companies 80 to 90%. Very few companies have compressed less than 20% over the last year. Now put that into perspective of that liquidity drying up, the cost of money becoming really expensive today, a compression in the public markets. What does this really mean for private companies and what their outlook perhaps looks like? And let's phrase it, and I know we want to extend the horizon, but our attention span is small. So let's phrase that in the next 2 to 5 years, 24 to 60 months. What does that look like?
So I think we have to, again, look at the backdrop, right? You're right in that those valuations have compressed in a year. Why? That is because of the interest rate hikes we've had, right? We talked in one of the pre-calls that the Fed raised interest rates knowing that it would probably break something. They just didn't know what exactly it would break, but they're not doing this for giggles. They're doing it to try to slow the economy. When you have such an extended period of time of interest rates on the floor, no one can make yield anywhere else. Capital finds its way into the craziest things. We had a bubble in crypto. We had a bubble in fine wine, antiques, classic cars, baseball cards, you name it. Capital was trying to find its way into things. When capital is very cheap, people tend to overbid because they got to put the money somewhere, and everyone tries to get into the hot thing. Private markets also by default are less liquid than public ones. So price discovery is very hard. It's kind of an eye of the beholder kind of thing, because you might only have a roadshow with 20 or 30 VCs, and that's your universe, right? If you're in a hot sector, like this is what happened with crypto, you're in a hot sector, you've got a deck that says you're going to change the world. Joe, the VC's got more money than he can deploy. Everyone's getting, quote, rich on crypto. So he writes a check. Now, fast forward into a different economic environment, he massively overpaid, right? And that's what we're seeing now. We're seeing this retracement. It's not that these valuations are cratering because anything has necessarily changed with the fundamental outlook for these private companies. They're cratering because they were too high in the first place. And now they're going to adjust. In some circles, you'll hear that people are saying this is healthy for that private funding ecosystem because it prevents this FOMO and, you know, write a check with 2 kids and a laptop and a good PowerPoint. We've seen this movie before, right? We had this with the dot-com bubble. We had this with, I mean, you pick a bubble. We had this in the 90s. We had it in the 80s. I mean, there's always been the newest, coolest, whatever that attracted over capitalization. Going forward, I don't think everybody should, though, now run to the exits. This is a normal retracement. When you take that macroeconomic view, this is a normal retracement back to the mean, so to speak. And within a couple of years, I would not be very surprised to see the venture ecosystem and the private markets ecosystem, you know, trucking right along and more or less, maybe not back to the crazy valuations of last year, but digested the interest rate rises we've had, the new macroeconomic overlay, and funding companies as they were before.
You know, what's a little bit of a thought-provoking for me, you know, we looked at the numbers over the last 3 generations, which is roughly, you know, 75 years.
Yep.
And we look at your graphs and we're trying to remember those, and let's project forward.
Yep.
Let's not call it 75 years because that time horizon is too long forward, but let's project 25 years. And if we look at the way that the crypto environment bubbled up, if we looked at the way we're looking at the distributed ledger and everything's being decoupled, and you're the chair of the crypto practice at
Yes,
Burkland. So what do you see there? What's going on here over the next? I mean, okay, so I have a bunch of money in the 401, in my retirement plans, in the 401k, in the public markets. I thought I was making a lot of money. I was going to retire next year because I had, you know, a shitload of appreciation.
Right.
Did I say a bad
You
word?
did, but that's okay. We'll beep you out later on the tape.
Now, what's happened is over the last year, I've actually been pushed back 10 years.
Yep.
All of a sudden, my retirement and my income on a retirement basis is like, doesn't exist. It's like 1/2 of what it used to be before. I could probably hang on a little bit, but there's a lot of younger people coming into the investment market. What are they looking forward to in the next 25 years, and what's happening there?
Sure. I think when you talk about crypto and DeFi, you're seeing the utilization of crypto technology, distributed ledger technology, all of that sort of stuff. And you're seeing in my opinion, it's one person's opinion, so take it as it's being given. You're seeing the birth of an entirely new class of investment mechanisms, rails, possibilities, right? It is still walled off from the public markets because of this raging debate about whether these are securities, whether they're not, and all that. But think of what DeFi at its core is really doing. DeFi is providing yield on a value of tokens that's being utilized to grease the skids in some ecosystem, whether it's a blockchain or whatever, right? And so what is that really doing? It's cutting out everybody between you and a return on your money, right? It's a utility yield versus a financial yield, which is what we've always had before. It's fundamentally not credit in the true sense of the word. It is loaning somebody your garden hose so they can water their plants, and in return for that, you're getting a yield on what that garden hose cost. That one thing, that one portion of crypto is going to fundamentally change the way public markets work, or at least how investments are viewed from a yield perspective, right? And that's one of the reasons why when you talk about the next 20 years, what does that yield curve do that I just told you about, or that 10-year curve that has spent 43 years going down? It's going to have a long bottom, a saucer bottom, where we kind of bound around here for a little while, and then it will start going back up again, because ultimately the cost of capital is going to get squeezed on one side, then raised on the other. We're going to get more and more productive. Our efficiency is going to get higher and higher. You look at the productivity rate in the economy right now, and it's miles above what it was in 1980 because of the advent of all of the, look at what we're doing right now. The fact that we're on this conversation on Zoom is a good example of what has compressed all of these value generating mechanisms inside the broader economy, right? And Alan Greenspan used to say that productivity is, for those of you who don't know Alan Greenspan, he was chair of the Federal Reserve for years in the 80s and 90s. Productivity was the single greatest economic factor to influence GDP in the world since the Industrial Revolution. And we're not done with that. If anything, we're just starting. The other thing I want to mention is the disintermediation that crypto and DLT is going to bring to the broader public markets, the private markets, really everything that has to do with the transfer of property or value or a thing between two parties. That is going to collapse. It's, it's not there yet. Some people are still working on it, but it's definitely happening. And we will find in that 20-year horizon, the securities definitions will have changed. The mechanisms with which securities are traded will have changed. And I say this a lot, the cost, the speed, right? And the accuracy of those trades are going to go through the roof. The speed and the cost will go down, the accuracy will go up, and we will find a much different landscape awaiting us there.
So I'm going to use the next little blurb for Linqto to pose the next question and some of the challenges and advantages that we may see. There are a lot of folks here on the, sorry, I've got flying jets in the background here.
Awesome.
For Fleet Week in Florida. But so some of you may know, and a lot of you may not know, why Linqto was created. It was created to democratize access to private companies, make it easy, accessible, and affordable for the traditional accredited investors to invest in private companies rather than before they become a public company, before they go through an IPO. We are doing this on our platform, as well as the stores that you can download the app. And we've as accredited investors, we've always had this FOMO as we were looking at all of these companies. Think about Google or Amazon or any of these large public companies, that before they went public, how could we invest in these companies? How, as an accredited investor, that I wanted to spend $5, $10, $15, $20, $50,000, how could I get access to these pre-IPO companies? Where there was never an easy way to do this, and what we've done at Linqto is made it easy, affordable to do this. And the way we do this is by acquiring equity, call it option, helping employees of private companies convert their options to shares, or buying shares in these private companies, then putting that on our platform, and then allowing accredited investors to partake in the investment of private companies. We've got about 30-something companies on our platform right now. I got to phrase this, I'm not an investment advisor, so do your own research and your own due diligence to make investments. So I've covered that. But as we go through this process of acquiring shares of employees, founders, and investors from private companies, the question that keeps coming up is how do I value my shares in these companies? It was easy in 2019 because the last valuation round made by VCs was the benchmark, and they were hoping that things would become an IPO and the valuation of that company would further rise during an IPO, and that was an easy determination. And now with the compression in the markets how do employees or founders actually understand the value of their company before selling to someone like us or putting it on a broker side? And given your experience and background in dealing with private companies and creating options and shares for employees and founders and investors, how are we supposed to look at this?
So the private markets are at a disadvantage there, and kudos on building Linqto. It's a terrific platform, and it speaks a little bit to what we were just talking about, where eventually, I don't think there will be a huge delineation between public and private. It will be a secondary market in corporate equity, whether that's on a platform that's public, like the stock exchange, or it's a public that it's private in the sense of like what you guys are doing. At the end of the day, it's a secondary market for investors to trade. The private markets, though, remain at a disadvantage because of that price discovery mechanism. The liquidity is not there. People debate all day long about whether IBM is worth its current share price or not. You've got this army of analysts that pore over these numbers and they come up with a target price or an opinion, buy, sell, hold, whatever, right? So you've got this whole mechanism there that's doing that valuation analysis. Private markets don't have that. They don't have the numbers and they don't have the participants in a particular company to provide that level of price discovery. So private companies are still kind of reliant on an independent third-party valuation of that firm. And that's what a lot of your founders will have heard. It's this 409A valuation that is named after a section of the Internal Revenue Code. And it provides a mechanism for a third-party valuation specialist, whoever that may be. It shouldn't be the company. It shouldn't be the Burkland folks that are working with the company as a CFO or anybody allied with the company. It should be truly a third-party firm. And they arrive at a very, in my opinion, imperfect, but probably the best you can get valuation. Companies are supposed to do that 409A at least every 12 months, or when there is a significant event, maybe a big option grant, maybe a big VC investment, something that sort of moves the ground underneath that company. The reality is, though, that is still just a single opinion. And until we get secondary liquidity in private markets, wider, bigger, broader, better, we're going to be struggling with finding what that true valuation really is. And that speaks to the valuation volatility that you just described. 2019, it was, $1 billion. 2023, it's 300 million. And I still have the same number of options. So there is a real need there to broaden this base and get us to a place where we have adequate price discovery in private markets. Hence the need for your platform.
Yeah, well, thank you. That's, we're trying. Obviously, we struggle with the information and try to do the best we can in that. But as we look at, we're coming up to an environment where a new generation of investors is starting to crop up. They're aggressive learners, like most of the folks on this webinar today are here because they want to learn something that they can utilize to make sound investments. And given what you've seen, there's a couple of points I want to touch on too, and I know we don't have the time to go in depth with a couple of different things, but I want to touch on the topic, and then we'll get a poll from the investors, the investors and attendees here, whether this is a topic that we want to cover a little bit more. So we're looking at distributed ledger, we're looking at DeFi, we're looking at crypto, and crypto is not a bad word. A lot of people say crypto is a bad word. It really isn't a bad word. It's just a technology, right? It's using cryptography to create a technology that does
distributed immutable ledger. Yes,
exactly. But I want to put three things on the table here that I want to explore more. Those two, distributed ledger, DeFi, crypto. The question really of how valuable are the public markets in doing what they do or what they have done over the last 3 generations, or let's call it 2 generations, in providing a return to your investment portfolio. But we've seen several things change. And one of the major changes taking place right now is the decoupling geographically, culturally, and politically from the US dollar.
Yeah.
Over the last 3 months and accelerating rapidly, our country saying we no longer think the US dollar is a stable currency to peg our valuation on. So we're doing things independently of basing using a base. Gold standard's gone away. Bitcoin was in contention to be a standard to be based on as a valuation. That has cultural and political and geopolitical issues, and now countries are decoupling from this. So geographically, things are changing. What are your thoughts on this?
I think that's definitely true. And I think it's one of these sleeper trends that we have to pay a lot of attention to, because talk about something that changes the ground truth underneath financial markets that have been in existence since the 1900s, early 1900s. The shift of the dollar's position as a reserve currency has a lot of complicated reasons behind it, but primarily, obviously, the economic increase in China's weight in the world, right? The rise in our interest rates from 450 basis points in 6 months has certainly shaken that tree a little bit, because it has been extremely destabilizing to financial markets around the world. Not that they don't like the dollar having yield. It's just that the speed with which that yield changed is having a hard, it's creating a difficult environment for people to adjust. It's not just the United States that's dealing with this. Look what happened to Credit Suisse. Credit Suisse had been having problems for a long time before it broke. The other thing I think we should throw into the mix here a little bit is when you look at inflation and you look at the underlying causes of some of that inflation, and you look at things like the Russian invasion of Ukraine and the sanctions that were placed on that country, and the global economic expectation to sort of play into that, I think there's a distrust a little bit of what the reserve currency's volatility is. For better or for worse, the reserve currency should not be a terribly volatile idea, right? It should be something that is relatively stable. But I think certainly since the pandemic, and maybe during the pandemic and since the pandemic, the US dollar has been anything but stable or unvolatile. And I think people are voting a little bit with their feet there. They'd like to redenominate some of this into what they perceive to be less volatile currency. My 2 cents. Complicated topic, though, definitely worthy of another whole conversation.
Yeah, no, I actually want to take a poll from the audience here. Is do you think, I'm asking the audience, do you think we are facing some actually massive economic changes and due to the decoupling and all from the US dollar by various countries, and starting to do, BRIC countries are doing it. You look at China and Ukraine, you look at Saudi and Africa.
Yep.
They're no longer trading oil on the dollar. It's like your individual currency is fine for you to trade with me. And all of a sudden we're losing ground in terms of stability of the US dollar. So if you guys on this webinar want to hear more about that and how distributed technology and crypto and changing in the geopolitical environment in regards to the strength of the dollar and the economy is a worthwhile topic, please just respond in chat, and we'll get Steve back.
Yeah, well, I would love to dig into that. I think it's foundationally one of the most important long-term trends that particularly younger folks on this call should be aware of. Like it will change the dynamic globally in terms of trade, in terms of finance, in terms of interest rates, in terms of funding from private companies. I mean, like it is a foundational sea change in how the world works, and you guys should be paying attention to it.
Yeah, because it's scary a little bit.
A little,
actually.
a little. Things have a habit of seeming scarier than they end up being, though. I mean, there's a lot of, well, we can get it. There's another whole conversation. We can get into that. I think it has opportunities associated with it too, though. I think we should not neglect talking about that when we talk about this again.
Actually, that's a good point, Steve. Let's talk about the opportunities that exist, because we are investors at heart.
Right.
And,
exactly.
And as an investor, we want to try and understand the opportunities and be able to be educated in these environments to make the right decision.
Right. Who wins, who loses, when they will win, when they will lose, and be on the right side of that stuff. We do have a Q&A question. I don't know if you wanted to get to that yet, or
we actually already did through.
Oh, good, great.
Okay, why don't you answer it from Richard? That Richard, I thought I did a little bit of this response in the Linqto brief, but let's go ahead. From someone, Richard asked the question, for someone with equity as employee benefit in a company going public, is it more advantageous to piggyback on the initial IPO shares sale or to wait? Considering the lockup period that follows for the company to be public before selling, I'm concerned about being too early in the selling process.
Right. That's a really good question. I mean, it all comes down to what you believe the prospects of that company are. Google went public at $85 a share. A lot of people thought that was massively overvalued when they did it. And a lot of people didn't play because they're like, there's no way they're going to keep that valuation. Whoops. Right. If your company, if you believe the prospects for your company are really strong, and you're going to use this capital to grow, and there's a lot of support, and you've got a strong book runner in the IPO, you've got a Goldman running it or a Morgan running it, somebody who's really going to move stock, you're probably better off holding and waiting until after the lockup is over. If you don't really understand who they convinced to help take you public, you don't really think the company's been performing that well, you're a little concerned, and take the IPO. Take the initial price, and at least with a portion of your equity. It's one of those things too that you never probably want to bet all on one horse. So if it's a significant portion of your ultimate net worth, you don't want to maintain that concentration longer than you need to. I had a good friend and a colleague years ago whose company we helped take public, and they, this person had way too much of his net worth piled into the shares of his company. So he sold a bunch in the IPO, he kept a bunch in the firm, and he put the rest into muni bonds, so that he knew that he was safe. It comes down to what your personal risk tolerance is and how well you understand what the company is going to be doing 2 years from now. That's the horizon.
Okay, I think thank you, Steve. We're coming to the end of our session, and if you want to close us out with a few words that may have not touched on, but will not allow you to sleep tonight, and you want to express your thoughts here,
there you go.
Please share.
I want to just encourage everybody to realize that the markets are a fluid place. They're never better or worse than they were 2 years ago, 10 years ago, whatever. They're different. And each phase of a market, each new construct, each new technology like crypto and DeFi, they present, like we talked about earlier, opportunities, challenges. They have negative impacts, they have positive impacts. And for investors, the trick is always to try to find things that you think will accrete in value without taking more risk than you are comfortable with. And that's really the secret. Understand the macro environment that you're in, learn. And then the last thing I would leave everybody with is an admonition that I was given by one of my mentors way back, right after the October 1987 crash, not to date myself too much. Market pricing ultimately has a behavioral finance component to it. People move in waves. We were talking earlier about price discovery in private companies. At some base level, a share of equity is worth what somebody's willing to pay for it. People move in, we used to call them sheeple. The craze will show up in whatever the newest, coolest thing is. Were Bored Ape Yacht Club NFTs worth what they were being sold for 2 years ago? Yeah, people were willing to write that check. Would they write that same check now? Probably not, right? But it was a thing and in a moment of time that had a lot to do with that macro update. So a macro overlay. What I encourage all of you on the webinar to do is view the financial market in which you're investing as a moment in time that has this overlay. It's got good things about it, it's got bad things about it, but it isn't really better or worse than the one yesterday or the one that's going to be tomorrow. It exists within it, and you want to bet on companies that will succeed regardless, that are going to have an application, that are run by good people, that have adequate financing, that are paying attention. We talk with startups sometimes and they can't find their tax returns. You know, like you want to be behind companies that are strongly led, have strong application, and are well financed. That's it.
Thank you. So I'm going to ask a question, Stephen. We had close to 130 people registered for this event. Anyone who's registered will be able to view this recording.
Great.
There might be some people who might want to reach out to you.
That would be great.
With a company or a choice or a thought. Can we include your email or?
Of course. Yes. Yes.
Okay,
Shall I
so
give it out now? It's slord, so S as in Sierra, and then Lord, Lord, like in the church, at BurklandAssociates.com. That's spelled exactly the way it sounds. One day I'm looking forward to working for a company with like a 3-letter name, so I don't have to type Burkland Associates all the way out every time I do my email.
Like Linqto, Linqto.
Yeah, it's very easy. And I would be happy to talk to anybody who, I know we didn't get a chance to really dig into a whole bunch of stuff we touched on. So anybody who has questions, please feel free to send me a quick note and I'm happy to dig in deeper if you'd like.
Thank you. And we've got an audience response, which would like you back to talk about looking into the future and how we can learn aggressively to invest better in the changing landscape. So we'll set up a time with you there. I'd like to thank everybody. You will have, after we've spent a little bit of time editing this video, you will find it on globalinvestorconference.com site. It'll be uploaded there. For everyone that's registered, we'll get a copy of the video as well as the link to the next event and Steve's email. Be respectful of how you use that.
Yes, please.
I want to thank all of you for being here. I want to thank Steve for sharing your expertise, background, and knowledge with us all. And I'd like to thank the Linqto team as well for putting this together. If you're not already an investor on our platform, let us know how we can assist. If there are any questions, please let us know and we'll get back to you with that. Thank you, Steve. Have a wonderful weekend coming up. And thank you everybody for being here. Thanks. Bye.
Thanks for having me. Enjoy Fleet Week. Cheers.
Yes.